One of America's top aircraft leasing firms just dropped $2.2 billion on a fleet of commercial jets from China. Not Boeing, not Airbus, but China's brand new C919, a plane that until recently, hardly anyone outside Asia took seriously. This wasn't a niche company testing the waters. This was GE Capital Aviation Services, or GECAS, a global heavyweight with hundreds of planes leased to airlines worldwide. And they just ordered 20 Chinese C919s. It's like if Pepsi suddenly chose to stock its vending machines with a new soda from the other side of the globe, even though Coca-Cola was always just a phone call away. Why would a major US firm from the very country that built the first passenger jet, the jumbo jet, and the Dreamliner, put its money behind a Chinese newcomer over the giants Boeing and Airbus? Is this about cost savings? A calculated play for the future? Or is it a sign of a deeper shift in the global balance of power in aviation? Today we're breaking down why this $2.2 billion order might not just be another business move, but a signal that Boeing and Airbus's reign could be facing real competition. And the skies may be shifting for good. For nearly 100 years, two companies have ruled the skies, Boeing and Airbus. These weren't just leading manufacturers, they were the aviation industry itself. Boeing, born in the US, created the world's first commercial jet, the 707, back in the 1950s. Then came the iconic 747, the jumbo jet that revolutionized global air travel. Later, Airbus emerged as a serious contender, backed by European governments. With aircraft like the A320 and the massive A380, it quickly caught up to Boeing and began dividing the market. These two giants became the go-to names. If an airline needed a reliable fleet, they looked at Boeing or Airbus. Not just because of performance, but because of trust, decades of safety records, established service networks, and proven reliability. For a newcomer to enter this space, almost unthinkable. Imagine trying to sell a new phone in a world dominated by Apple and Samsung. That's what China was up against. Building a large commercial jet isn't just about putting wings on a body. It requires cutting-edge design, global suppliers, international safety approvals, and most importantly, the trust of airlines and passengers. Even advanced nations like Japan and Russia, with long histories in aviation, couldn't crack this market. So when China said it would build a rival to Boeing and Airbus, most experts dismissed it immediately, but that didn't stop them. When China first revealed its plan to develop a large passenger jet, the C919, the world barely blinked. Many doubted it would even take off, literally, because building a jetliner isn't like making a car or a phone. It takes decades of experience, billions in investment, and an obsession with safety. Even the smallest design flaw can lead to disaster. So early on, critics labeled the C919 as a vanity project, a paper plane that would never fly. They said it could never match the range, fuel efficiency, or trustworthiness of Boeing or Airbus models. And in some ways, they had a point. The C919 lacked global certification. It had no track record. It had never flown outside of controlled tests. But China wasn't trying to win overnight. They played the long game. Behind closed doors, teams of engineers, government officials, and private firms kept working. They tested prototypes, fixed flaws, reworked designs. And in May 2017, the C919 finally completed its first successful test flight. It was a huge milestone. Proof that this was no longer just an idea. It was real. And China wasn't just building the plane. They were checking every box needed to get international safety certifications, the gold standard for global buyers. Fast forward to now, and the numbers tell a different story. Over 1,200 orders have been placed. More than 30 airlines have signed on, not just in China, but in countries like Germany, Thailand, and Brunei. This was no longer about national pride. The C919 had arrived. It was now a serious player in the commercial aviation space. And that takes us back to the GE deal. Because when one of the biggest American leasing firms makes a move like this, you have to ask, what do they see that others don't? Let's break down the decision that stunned the industry. In May 2023, the Australian reported that GE Capital Aviation Services, GECAS, had placed an order for 20 Chinese C919 passenger jets. The deal, valued at $2.2 billion. Now here's why that matters. GECAS isn't some small regional player. It's one of the largest aircraft leasing companies in the world, with over 1,000 aircraft in its fleet and clients in more than 75 countries. They lease aircraft to all kinds of carriers, from budget airlines across Asia to premium names in Europe and North America. So when they place a major order, the entire aviation world takes notice. Now here's the twist. GECAS is based in the United States, the same country that gave us Boeing, Lockheed Martin, and some of the most advanced aerospace technology ever made. So why would a top US firm turn to a brand new Chinese jet? It wasn't about symbolism. It was a calculated business move. GECAS needed planes that were affordable, efficient, and, most importantly, available on time. And the C919, which had now passed certification, completed testing, and built up momentum, offered something Boeing and Airbus couldn't promise at that point. This was the moment the industry realized the C919 was no longer just a domestic experiment. It had gone global, and Western companies were now betting on its future. But the question remains, why choose the C919 over Boeing or Airbus? The answer? Cost. In aviation, every cent matters. Airlines and leasing firms operate on razor-thin margins, and aircraft are one of their biggest expenses. Here's where the C919 stands out. The price of a Boeing 737 MAX 8? Around $121.6 million. An Airbus A320neo? About $110.6 million. China's C919, roughly $99 million. That's a discount of nearly 20% compared to Boeing. Across 20 planes, GE Capital Aviation Services could save more than $400 million, just on the list price. But the savings don't stop there. Modern aircraft must be fuel efficient, low maintenance, and reliable. The C919 was built to meet these expectations, using modern engines, sleek aerodynamic design, and lightweight composite materials to cut fuel burn and operating costs over the plane's lifespan, typically 20 to 30 years. Even a small percentage drop in fuel use or repair cost adds up to millions per aircraft. For companies like GECAS, that's massive. Their entire business is built around maximizing aircraft value and keeping airline clients profitable. It's like running a trucking company. Would you pay $120,000 per vehicle for a popular brand? Or $99,000 for something that runs just as well and costs less to maintain? With a shaky global economy, inflation, and rising borrowing costs, the answer is obvious. Efficiency matters more than ever. The C919's pricing edge makes it extremely attractive. But there's another reason GECAS went in this direction. And it's not about China. It's about Boeing. For decades, Boeing was the gold standard, trusted by airlines, regulators, and passengers alike. But that trust has taken a hit in recent years. The turning point? The 737 MAX tragedies. In 2018 and 2019, two crashes involving the MAX killed 346 people. Investigations uncovered serious flaws, from software issues to gaps in pilot training to a questionable safety culture inside Boeing itself. The global reaction was swift. Countries grounded the MAX, airlines canceled deals, lawsuits and regulatory crackdowns followed. Boeing's production delays piled up. Even after the MAX was cleared to fly again, the damage was done. Airline confidence was shaken. Delivery schedules slipped. New quality control problems kept popping up. For some airlines, delays stretched into months. And for leasing firms like GECAS, waiting means lost revenue. Meanwhile, demand for jets is booming, especially in Asia, the Middle East, and parts of Africa. But even with full production lines, Boeing and Airbus just can't keep up. Order backlogs are huge, wait times stretch years, and every grounded plane is revenue lost. That's where the C919 offers real value. For GECAS, turning to China's COMAC wasn't just cheaper, it meant faster delivery. They needed jets now. Boeing couldn't deliver. Airbus was already maxed out, but COMAC had room in a plane that met their needs. It's classic market pressure meeting new opportunity. But there's another detail that most people miss. GECAS wasn't just buying Chinese jets. In a way, it was buying its own tech. Here's the little-known fact. The C919 isn't entirely made in China. A big chunk of its components come from Western companies, including major American suppliers. For example, the engines? They're supplied by CFM International, a joint venture between GE, yes, the same GE as GECAS, and French aerospace firm Safran. These LEAP-1C engines are the same ones powering Boeing and Airbus jets. So, when GECAS buys the C919, it's indirectly supporting GE's engine business too. Then there's Honeywell, which provides the avionics, the systems controlling navigation and flight data. Rockwell Collins, Parker Aerospace, and other Western firms also contribute key parts. Altogether, about 40% of the C919's parts come from US and European sources. So even though the C919 wears a Made in China label, it's really a global project. That's why firms like GE are willing to take the plunge. They already know the technology inside. And it shows how complex today's geopolitics and economics are. Even as governments clash over trade and technology, companies often find ways to work together behind the scenes. The C919 is more than a competitor. It's a model for future cooperation. So this $2.2 billion order, it's not just a purchase, it's a calculated investment in a jet that benefits players on both sides of the Pacific. The C919 is more than just a jet. It's China's clear message to the world. We're ready to be taken seriously in global aviation. And with GECAS placing one of the largest international orders yet, that message just gained major momentum. For years, Boeing and Airbus dominated like a two-player game. Together, they held more than 90% of the commercial jet market. But now, a third contender is stepping into the ring. With backing from one of America's biggest lessors, powered by Western parts, and supported by a nation with massive ambition. Will the C919 replace Boeing or Airbus tomorrow? No. It still has to prove itself long-term, with reliability, international certifications, and production scale. But the shift has already started. GECAS's move signals a turning point, not just for airplane orders, but for global business dynamics. It shows that economic logic can override political tensions, that companies prioritize delivery, savings, and performance over borders. And it's a reminder, even the strongest players like Boeing can't afford to fall behind. In the end, the C919 doesn't just represent China's aerospace rise. It captures a world that's changing fast. A world where supply chains cross continents, where alliances are fluid, and where emerging powers challenge the old order. Whether this marks a new era in aviation or just a disruption in the status quo, one thing's certain: the sky no longer belongs to just two.